Welcome, Michael. I'm sorry for the delay in the starting process. Welcome here, everybody. It's a pleasure to have you, Michael, and especially with the results you have just given us in Q2. We'll do this in 20 minutes, and we'll guide you through. We have approximately, we've taken, these slides, very well. So we'll guide you through the Q2. We'll go through the financial summary. We'll go through the industry outlook, and then we'll probably do a conclusion. So welcome here, everybody. And please remember that you can ask all your questions down below in the chat, and I'll ask them afterwards. My name is Tue Østergaard, and I'm from HC Andersen Capital. Welcome. So let's just take the overall brief introduction. I think the only change, Michael, to this one is that you now have a net asset value and some average broker values on this slide. Is that correct?
That's correct, yeah.
So I guess this must be pretty old, 43 kroner, Norwegian kroner per share. That cannot be the broker valuation now, at least.
No, and I think this is obviously what happens when markets kind of change, as we have seen so quickly, right? Is that basically a lot of the statistics and data points is kind of lacking a little bit behind. So as you say, this is obviously all based on the end of Q2. But we have already seen that the latest valuations coming out now, on some of the ships are up to almost 20% higher in that short period in between. So it is true that because of the higher earnings of the market, secondhand values and NAVs are basically moving on a daily basis in an upwards direction.
Perfect. But I guess just to give you a highlight, of course, now the share price is changing every day. And I think you have, was it yesterday, with all-time highs of 45 Norwegian kroners. And that is equivalent of a market cap of well above 22 billion now. And I think that the one I wanted to dig into was the commercial managed vessels, which has gone from 176 now up to 251. So that's quite a dramatic change in a very short time.
Well, this is actually from 19, as you can see, end of 19, but it's still a big increase in that sense. So it's not, yeah. So and it's something which we have, which we have, in a way also said most of the times, is that it's a business area in itself to manage other people's vessels, and it's a revenue stream that benefits the shareholders as well. So having these 110 vessels as it is today from third-party owners in addition, this year we'll probably have an annualized revenue stream of about $40 million. So despite that freight rates are high and we make a lot of money, I think it's not an insignificant contribution to the results in Hafnia that we do manage all these vessels.
We'll get back to that in a second. I just found it interesting that you're starting with this. Then about your acquisitions, you have this slide with impeccable timing of acquisitions, and at least that's correct. Maybe you should give us a few highlights of the story here.
Yeah, so obviously none of us had seen the situation that happened in Ukraine as to begin with. So the reason we actually pushed for these acquisitions last year, and I think we even talked about this during our last call here, is that we could see that the market was getting tight everywhere. So there were a low supply of new vessels coming into the product tanker market. Inventories have been drawn down to absolute minimum. And we have increased environmental regulations coming, which means that older ships is finding it more and more difficult to be competitive in the market. So when you looked into this, and particularly knowing that no new supply is now available until 2025. So if you order a new ship today, you will get it in 2025. And this has to be compared to a standard of maybe 18 months from your order to the vessel gets in. So we have such a high delay on deliveries that if you order something today, you don't know what market the ship will deliver into. So seeing that we have had about 3 years of control supply in a demand situation where oil demand was back to pre-COVID-19 was the reason why we pushed for these acquisitions. And obviously then having added the extra distance to transportation due to sanctions on Russian oil has now made, of course, that these acquisitions is super value accretive for the shareholders in Hafnia. And if you look at top right, if we take into account an annualized net profit of the freight rates that we are seeing at the moment, and we look to the increase of the value of the ships, just what we've seen so far, it's already around a $300 million value increase for the shareholders. So I think what this slide is all about is also to show that in good markets, everybody will make money. Every company will make money in the product tanker sector. But we'd like to be seen as an active management company, which over 11 years actually have grown and built and done things, which means that there's more value to come to shareholders than had you just been sitting and doing nothing.
Cool. And then we'll get back to if there's more acquisitions on the way, or at least you're thinking about that. But let's go into Q2. I mean, it's stunning numbers. It's huge numbers in terms of net profit and also cash flow. So obviously there will be a lot of questions about dividend and policy about that. But maybe you should just give your sort of view on the Q2.
Yeah, so there's no doubt that I mean, in Q2 we started to get full value of the extra ton mile, which is, again, you know, ships are sailing longer with the same cargo than before. So you know, freight rates we've seen is basically historically high, without any doubt. And you know, a lot of it, as I said, was driven by the fact that inventories were low. And when you had an invasion in Ukraine, there was a lot of worry about Russian oil being sanctioned. What do we then do? Where do we get the oil from when we can't get it from Russia? And most of that oil coming into particular Europe and the West has now had to come from longer distances. So most of this is actually driven by vessels sailing longer and by the fact that there's no inventories where you can just draw oil down to use. So it's that combination that has pushed the rates up. So it's a fantastic quarter. Again, second quarter, of course, the one that's driving first half, but we already know now that third quarter will be even stronger. So that's really where the full value comes in the third quarter of the increased market activity.
Yeah, and just pointing out that the Q3 you mentioned, believe you wrote significantly higher. Obviously you are well into the Q3 now, so that's almost comes with certainty. But is there anything you can tell us about the longer term here for Q4, for example?
Yeah, so I mean, already now we have business that goes into Q4 as well. So you know, I think that at least as far as we see the situation play out right now, is that we are coming closer to a full sanction by the EU on Russian oil in February next year. So what that basically means is that even though we have sanctions today, 50% of what Russia used to export into Europe is actually still ending up in Europe today. So when you reach February, that means that it's going to be zero. So in our view, we probably have extra demand, again, from vessels having to deliver that oil into Europe from longer distances to the equivalent of more than 100 medium-range product tankers. So if you kind of add another 100 medium-range product tankers into an already fully utilized market, in our view, we're looking into a very strong season, Q4 and Q1 next year as well.
Okay, we'll get more into that because I think there will be many questions about that. I mean, there's many questions about the dividend and the dividend policy. Maybe we should start there in terms of the dividend overview, because there will be many questions about this.
Yeah. Well, so our formal dividend policy is paying out 50% of the net profit, and we do that on a quarterly basis. So that's kind of point number one, and that's the policy, and that's also what we did here after Q2. I think what's important to say about dividends, and I guess this is kind of what you're alluding to, is that we don't have any capex coming up. We don't have any intention of spending money on new builds. We don't have any intention of buying secondhand ships and spending cash. We have basically fulfilled a growth strategy last year, which means that at the moment it's about returning capital to shareholders, either through dividends or through share buyback. We have some refinancing to do, but we can manage that out of the existing cash flow. So basically, we expect to be able to reduce our LTV over the next 2 quarters, and this will be without any effect for the dividend policy whatsoever. And after that, we'll be back to where we want to be from a balance sheet perspective.
So just to confirm, when you say Q3 is significantly stronger, that also you will just then confirm that you will get Q3 50% payout ratio again, basically.
Yeah, we have not changed any dividend policy. That's right.
Perfect. I think that's very comforting for many people that buys Hafnia because of the dividend policy among other things. And just on the share buybacks, because that's of course also something that you can sort of differentiate yourself with. Can you just make a few comments on that, please?
Yeah. So for us, this is, I mean, this is something we basically discuss every time that there is a talk about dividend and end of quarter, right? So it's just to emphasize that if you feel that you know the share price is not reflecting the value of the company, you know, we could also look at share buybacks. Right now, at the moment, you know, we've decided to continue with dividends, but it's just to underline, of course, that you know it's a discussion that takes place on an ongoing basis between management and the board of kind of which route to take in terms of this.
Cool. If there's any more questions to dividend, then please put them now, because otherwise we'll just go on. I think you answered most of the questions then. And then I think this is a very, very interesting slide, because actually it's the week starting Monday, the 15th of August. You put in the rates, and you also given us the coverage, which basically tells you that there's a significant upside for Q3 and probably also Q4 in this. Was that your intention, just to show the market where are we sort of in terms of the rates right now?
Exactly. I mean, I think honestly, we have no intention of trying to create confusion around what you're making and what it will look like. I think the challenge for everyone is that when you have markets that are so high and continuously go up, you know, obviously if you want to give guidance, you know, your kind of your low and high sometimes indicate such a big spread that is probably not even, it's more misguidance than actual guidance. So I think here at least what we try to do is to get so close to numbers so people can actually do the math themselves. They know the earning days we have, so it's pretty clear that you know roughly where we will end up for Q3. But it's also nice to see, of course, as we come into Q4, that at least we will be starting with numbers that are equally high as in Q3.
Cool. I think it gives you a good overview also of the coverage rates. Lars Jensen is asking about the chemical tanker business and the entrance into that a year ago. Could you just perhaps elaborate a little bit about that and your first early comments on that?
Yeah, so I think what's important to understand about those ships and why we did it was actually not so much because of chemicals isolated, but actually because these ships are product tankers. So they're more or less design-wise equal to what we had already. They just have an extra feature of being able to do chemicals. So the whole idea actually is to try to combine the best of two worlds. So instead of having, if you like, separate items and separate teams that only look at either products or chemicals, this is a consolidated group of people that at all time will look at, does it make more sense to do more chemicals than products at the moment? So we want to utilize the scale of 250 ships to have more knowledge about where we see markets are going and use the flexibility of our vessels to the optimal. So you should see more this as a triangulation combination opportunity for us, rather than we'll split up and be locked in a segment on its own.
Cool. Then I think there's some questions about if you compare your coverage rates to competition. I cannot validate that, so I'm sorry for that. But there's a question about your sort of coverage levels as to rates compared to your competition. I don't know if there's anything you can say, but that's at least a remark here.
Yeah, I saw that actually, and I think I mean, if you look at benchmarks, you know, over the last number of years and look at TC per days, you know, to be honest, I think you'll find that Hafnia is on the absolute top. So is Torm actually on performance. I can only see this as being a time differential in terms of when you actually advise what coverage you have, because you know Torm were out earlier than we were. There's nothing that indicates if this question is about have people done different things in terms of positioning or their vessels, I can say no. It will be a relatively similar way of trading ships. There will be a little bit of difference maybe in terms of someone have more LR2 ships than maybe us, but other than that, there's no fundamental difference in the way the ships are being traded as such.
Cool. Let's leave it this then. I just wanted to go then to this slide, because I think it's relatively. I think what you want to do is give people a sort of information about what this could be overall. Isn't that correct?
Correct. This was basically to follow a little bit on what we talked about before, right? On the coverage for Q3, etc. Yeah.
Yeah, exactly. So this is what you can. This is your reference to the market, and then I think what's more interesting is, of course, all we've talked about now is history, and then it's about the future and how you navigate this crazy markets. Should we just? I mean, there's demand side, of course, which has gone bananas basically in terms of this, and there's a lot of questions about this Russian ban. So maybe you should take that one more time and how you see this will impact the demand on various trades.
Yeah, so basically, before we even talked about the Russian oil sanctions, as I said earlier, we were still convinced that you were going to see this year being a much stronger year than last year for the reason I already mentioned. So what we have been added to a market that was going to be fundamentally stronger is that short-haul transportation from Russia into Europe has been replaced by voyages going from the Middle East back into Europe. So much longer occupation of vessels. So, and what it has meant in terms of demand is that we've actually seen that demand technically has gone up by 6 to 7% due to the increase in distance that ships are sailing. And so if we look at that 6 to 7%, I mean that in itself is an extraordinary big number if you compare it to maybe net addition to the fleet of 2%. So that's one thing. What I alluded to before is that we have not seen the full effect of the Russian oil embargo. So when you come to February next year, you will lose the other 50% as well, which means if you follow the same logic, there'll be more longer ton mile for transportation of refined oil products into Europe. The risk of this, the way we see it at least, is that we don't see a lot of sector-specific risks, within the foreseeable future, but we do see a risk of recession and the whole macro environment putting a dampening on consumption. But if we then go back and analyze the previous recessions and see what happened to oil demand during all these periods, basically oil demand has never dropped more than 2.5% to maximum 3% during the past recessions. So as long as this ton mile, which by the way for us is a structural change, Europe has decided to make themselves independent of Russian oil and gas. So this will not come back as it was. This will for a long time give us extra ton mile. Then we could even live with an absolute demand reduction of 2 to 3% in a recessionary scenario, and still have a strong market, because ton mile, as I said before, will make up for a lot more of that going forward.
Okay, I believe you have a slide on that. Yeah, this is one of the Russia thing I think you're addressing on this one, isn't it?
Right. Yeah.
Yeah, and also the ton mile. If we just do that one, I think it's here, right?
Yeah. Correct.
And for me, I'm actually this slide, it gives you an overview, but I'm surprised that the ton mile effect is not even higher. But that's of course history. This, and then you believe the ton mile effect will actually increase. Is that what you're saying?
That's correct, and I think also we should remember, and the people in this call that has been following this sector for a while will also recall that we have been speaking for quite a number of years about the way that refining infrastructure has changed, so that you have closures in the US, you've had closures in Europe, and new refinery capacity in Asia, and particularly Middle East. And what we are seeing now is that the two largest refineries, and I think you should have a slide here about it as well, in Kuwait and Saudi Arabia, have now come up and is only beginning to produce 15-20%, but they will come up to full capacity throughout the rest of the year. So there is a new supply of refined oil products coming out of the Middle East that is scheduled for exports, that is well set up for supplying a lot of this refined oil that will need to be replaced from the sanctions of Russia.
So if you summarize your sort of demand thinking, I mean, obviously there's a macro negative and because of a possible concession, and then there's a structural change, which is the ton mile. Is that a fair way of saying it?
Yeah, Absolutely.
And then we haven't really discussed the winter market because normally I believe September, October, we start to see a winter market with significantly higher rates overall. Is there anything we should be aware of in this winter market compared to previous ones, apart from the Russian thing?
Well, I think if you look at, and I think maybe you can find the slide where you have some inventory statistics as well.
Yeah.
But you know, I think if we look into where inventories are built in terms of clean petroleum products, diesel and gas oil for heating purposes, etc., it's pretty clear that you're seeing at the moment that inventories are low in the consuming parts, and inventories are beginning to build in the export areas. So I think coming into the winter, there will be a struggle for heating oil for sure. And what we're seeing now is that the conversion from gas to oil is taking place. So there's an increased pressure on diesel and gas oil in general. So it's very difficult to see that you're not going to see increased activity during a winter season, because you're going to have the same issues that we have just discussed, which is that when you don't have inventories in the consuming areas, you'll be fighting and scrambling for getting the finished products as soon as possible. And I think this is what technically drives longer ton mile for ships in general. So our view is that you're going to just continue to see the same trend, but it'll be different products destined for the winter markets that will drive the market.
Cool. There's a question about some technical requirements that are introduced early next year. I just want to take it here. I don't know exactly what the question is referring to, but do you have any comments as to technical changes?
Yeah, so I think what's referred to here is, which is correct, that as of next year, there will be an implementation of, well, first and foremost, of something called the EEXI. And what that really means is that it's a design feature. So what the regulators are trying to do is to make sure that vessels on the design basis have a more economical design structure. So new builds is one thing. Now you can build new ships up to new design, but they've introduced some rules on second-hand ships. That means that if you are an inefficient old design vessel, you have to either retrofit with things that will improve your fuel consumption, i.e. lower emissions. And because of that, I think there's been this kind of view that it may mean that ships will slow down and therefore again reduce capacity to the market. I think one has to be a little bit careful with these two things. I think on the design side, what it really means is that ships that were built in the old days were designed to go really fast. So it's a bit like having a car that can go 200 kilometers per hour. Now you need to derate the engine, so you can only do 180. But the reality is you're always only done 140 on the highways, or 130. So we don't think that this particular thing will have a big impact on supply. What will have a big impact is another feature that's coming, but probably only in end 23, 24, which is, as a company, we need to show that we are every single year reducing our emissions on an overall basis. And I think when you look at it from a fleet perspective, I think there will be a lot of owners that will not invest in retrofit and improvements on their ships, but they would rather just take the break and go slower. And once we hit that, then I would agree to this statement that by the end of 23 coming into that, then there is a likelihood that a lot of owners will choose the easy opportunities just to slow down speed. And then again, that would be positive for the supply of ships into the market.
While we're at it, Michael, Kim Mikkelsen is asking if you have this bullish view on the rates in the future here, will you then hold back a bit about committing to your coverage rates? I think it's a fair question, but also perhaps interesting to hear your answer to.
Yeah, no, that is our strategy. So our view is that it's too early to log in, and what you can log in now is mainly on a 12-month basis. And to log in on a 12 months, we actually feel that we have sufficient visibility to stay spot as long as that is the case. We think as you come into Q1 next year, most likely there will be more interest from the other side of the table to do contracts and coverage for 3 years. And once we see 3 years at interesting rates, then we'll start looking at locking in. But at the moment, we're not doing it.
Cool. There was also a previous questions. I mean, obviously we're in very, very turbulent times and the rates are very, very strong. And is it possible at all to give a more sort of 1 to 3 year horizon on the demand side here? Or are we back to old fundamentals? I think this is a more structural question again. I know the ton mile effect, but I think it's a fair question, to be honest.
No, but I think there's no doubt that this year and the next 2 years ahead of us, even without the situation in Ukraine and Russia, would be strong years. The question is always, when you have strong markets, is how much more help do you need in order to push it really through the roof, right? But they would have been strong markets. We will consistently have an element of ton mile on top of this from the situation in Russia, because as I said before, even in our view, after a hopefully soon anyway, end of the situation there, you'll have structural changes that will improve on the demand side. The closest I can get to really answering this question specifically is that what you always want to look out for is what I call full utilization of ships. So what happens typically in our market is when all ships are sailing, the market will go to next level depending on sentiment and how individual people every day negotiate. Because then it's not down to any form of logic. What will matter is you will push the freight rates until the point where the people paying for the transportation are saying, my trade doesn't make sense at this freight level, so I'll drop the ship. At that point, freight rates will retract a bit. So that's really the game here, is that you'll see owners pushing to the limit. People that do the trading, that buy the transportation, will simply just say at some point it doesn't make any sense anymore. So that will be the dynamic rather than normal supply demand in a stable market. So that's why you're going to see the swings also going forward.
Yeah, cool. Let's leave the demand side for now, Michael, and go to the supply side, because we've discussed this over the past couple of years that supply is actually not changing. So, and you just said before, you cannot order something now, and you also said that you will not order. So is there anybody you see come into the market for some strange reason, or do you see any changes on the supply side compared to 3 months ago?
No, it's the same. So basically, yards are full. You have to remember as well, shipyards are not really super keen on building our type of ships. They're not super keen on building dry bulk carriers either. I mean, shipyards want to build complex vessels because that's where they make more margins. So for them to build big container ships or big gas carriers as they're doing now makes a lot more sense. So they are not pushing for orders from us or anyone else. And as you can see on prices, it has become so expensive that you have to go all the way back to 2008 to see anything similar where prices for new build were as they were. So what I think you will see slowly but surely over the next couple of years is that there will be a few like project ordering. So for instance, if an oil company wants to have a ship and is willing to give you a 5-year contract, if you build it, then you'll build it. You'll have safe earnings for 5 years. And the oil company will use the vessel to promote maybe LNG or one of the other products as they start to come into the market slowly. But to imagine owners going out and buying an old design tanker that will last until 2050, knowing that going into close to 2050, the transportation market will look very differently. That's not likely at all.
No, fair enough. So no change is, I guess, good for Hafnia in this respect. Is there anything on the military side? I mean, is there any sort of crossover that this actually will become even more difficult because the world needs military ships? I don't know if that has any impact whatsoever.
It could have. I mean, what we've normally seen though is really it's been during times where there are a few orders that yards have been fulfilled with military ships, right? So it's actually been more a strategic positioning. When yards are not having commercial ships, they have a tendency of filling up with military ships. Of course, the world has changed. I appreciate that. So it's a good question. I actually don't know, and we haven't heard back from yards whether that's going to be a pressure as well.
No, fair enough. And then you consider yourself an asset trader. So I think Jens Black is having a good question here. Do you actually consider using these high new builds to be selling secondary ships into the market simply to trade the market?
Yeah, so we actually have done that also last quarter. So we have disposed of a few of the older ships. So vessels built in 2003, 4, and 5, we have sold, mainly because one, prices had gone up, but more importantly, a lot of these older ships are now moving into a time where their next dry dock at 15 years and 20 years are going to be very expensive. And we felt that to begin and spend that amount of capex, knowing at the same time that we're going to have environmental pressure of continuously improving in our fleet, has actually done that we've sold quite a number of those older ships. And the average age of our fleet today is down to 7.7 years, which should be seen against an average age for the entire product tanker fleet worldwide of more than 10 years. But we will not, the idea is not to sell modern ships as such. So what we've done is just to clear out from the back end of the very old ones that we had.
Cool. I think that's what we had in mind on the supply side. So if you have any more questions for Michael Skov, the CEO of Hafnia, please do them now. Otherwise, I think you should just, I mean, this whole ESG, we've been discussing it many times, and I sense that it's not so much a commercial thing for you, but it's close to Hafnia's heart to be ESG relevant. Is that a fair description, that you simply see this as something that if Hafnia needs to be a big company in the future, that you need to be relevant from an ESG point of view? And then you spend a lot of time on this, isn't that correct? Very
much so. And it's not just on the E side. I mean, I think it's actually for us, it's equally important, the S side and also the governance side. And I think, you know, overall, I mean, it kind of starts with really being a responsible company in the way you're set up and how you do things. But yes, and you know, there's no doubt that for us, this is important. And the way we kind of approach ESG is not to have a specific department or someone in a corner that has the task of running ESG. We want to avoid this becoming a compliance, which I felt it did the last time back in the zeros when we talked about CSR, that quite quickly became something about checking boxes. So everyone with leadership responsibility in Hafnia today has a responsibility around the ESG side as well. So it doesn't just anchor on a department of persons outside. It anchors on me as the CEO of the company, but it also anchors on all 25 people with executive management responsibility in the company. And we believe that drives cultural change, which is what this is really about. It's not about compliance. No, fair enough. Anyway, Michael, there's no more questions. Thank you very much for your time. I'm sorry we finished or started a bit late, but I think it was very interesting, and good luck with Q3. It sounds very interesting. So I hope we'll be back in a quarter from now. Absolutely. Thank you for all your questions. See you soon.